Right on time. Thank you guys all so much for coming. We know the weather was pushing some folks away, but appreciate your attendance. We're here today to talk to you guys about opportunities to invest in farmland. My name's Melissa Bermudez. I lead our investor platform here. So your main point of contact in terms of how to actually invest in farmland. And this is Peppo. He's about to introduce himself. And he leads all our diligence from the farming side and the Farmland Capital product.
Good morning. Nice to meet you all. I'm Peppo Peixeira. I'm originally from Argentina. Grew up in a farming family there. Studied agronomy, finance. Started my career like building a farming company. Was renting farms, growing corn, soybeans, wheat. And then I moved to the U.S. about 10 years ago and have spent basically 15 years of my life investing in farmland in different parts of the country.
Great. And as I said, my name is Melissa Bermudez. I grew up in Massachusetts. I've actually had to say there is some agriculture in Massachusetts. It's different than out here for sure. But yeah, I actually ended up going into finance and investment banking right after college, but chose to go back into really focus on rural economies, and that's how I ended up in agriculture. So was most recently building out the strategy and operations at a startup, and came here to really build out our investor platform and get the word out about these Farmland Capital transactions. So really excited to talk to you guys today. You can follow up with me anytime after this, and we're also in a booth downstairs as well if you want to stop by and say hi. We have tape measures, which are hot commodities. So this is what we're going to talk about today. FBN, I know you all have heard a lot about FBN, but we'll be talking about it from a little bit of a different perspective, which is the perspective of putting your money behind us. Peppo's going to talk about farmland as an asset class and what the investment thesis is there and why invest behind farmland. I will talk more about the Farmland Capital product, and then we'll end by talking about our investment opportunities. We're actually launching a new investment opportunity here at Farmer to Farmer, and we have a savings, an offering specifically for FBN members that we'll be talking about. So FBN, we were founded in 2014. We've reached a valuation of almost $4 billion. You've seen a lot of the employees here, but it's actually only about a third of the employees at FBN that are here at the conference. So we've got over 1,000 employees that span from the product and engineering side of things to obviously the expertise on the agriculture side. We've got an over 100-person team on the finance side of things of folks who have spent their entire careers in ag financing, obviously inclusive of Peppo on the investing side, and a whole team of economists and data scientists that are also fully behind the Farmland Capital platform as well, and that you're kind of gaining access to with the investment platform of FBN. We've also got a respected investor base that has chosen to put their money behind FBN, which includes Fidelity, BlackRock. You can see all the names here, as well as strong partners in agriculture that are really helping us kind of solidify our place in this industry. You all know why FBN exists. That says farmers in the middle, which is the position that makes your jobs a little bit more difficult, and why FBN is specifically here. We'd also add financiers and landlords to this equation. Many of you know that the financing opportunities for farmers, an option many folks take up is to rent land or to sell their land to landlords. This product is specifically designed to help farmers have a path to long-term ownership in their land. And it's yet another way we're trying to take advantage of FBN's member network and help give voice to farmers in this industry. I love this quote. I swear this is the most drinking the Kool-Aid quote we've got here, but a farmer that understands what we're trying to do, which is help farmers become more efficient and more profitable. And that's exactly the role of Farmland Capital as well. We are in this to help farmers have a path towards ownership in their farms and to support them in that. And why that's meaningful from an investor perspective is that we're looking for farmers and we're looking for the buy-in from farmers on the investment opportunities. And so when you have that sort of farming base that feels empowered by FBN's platform and has that sense of loyalty that Alec was saying on the previous slide, it's a farmer base that views FBN as a trusted advisor. Again, from the investor perspective, the reason that's important to you is it means that they're coming to us with properties that they need help financing with that are usually, in our case, either an older relative selling to a younger relative, properties that aren't ever available on the open market, things that folks really want to hang on to, and they're looking for help to finance that. That means that they're really high quality opportunities, and it means that there's better outcomes for you as an investor and better outcomes across all stakeholders. I know it's a hard thing these days, but we're really trying to build a win-win platform here on both sides. So for sure, definitely would welcome any feedback on any of this, but it's also something we'll come back to again and again as we continue to go through this presentation. So with that, I'll pass it to Beppo.
Thank you, Melissa. So if we think of farmland like it's a really important asset for the world, it's where most or all of our food is produced, but they do not make any more land. So over the years, we need to produce more, extract more out of that land. So since 1960, the acres available per person in the world have gone down by 50%. That puts a bit more pressure on each acre to produce more. That results at the end of the day, like in each acre becoming more valuable. If we look back at land as an investment, going back to 1990, the farmland has traded very closely with the S&P in terms of returns. You're getting an annual return every year, and you're also getting the appreciation, really outperforming other investments like gold, silver, even the treasuries or like bonds. And it's also like a really robust investment. You, during recessionary periods like crises, COVID is one of the most recent ones, farmland continues performing. People need to continue being fed, so markets can go up and down, but land's a pretty robust investment. And it's also like, has low correlation with other assets. We were just talking about like what happens with the stock market, but with bonds, it's also negatively correlated. And when you look at what happens with inflation, it has a really high correlation. So if there's inflation, land is a good place to store value. When dollars or any currency, I come from Argentina, so I know how currencies can get devalued. And yeah, when the currency is worth less, typically land is a good store of value because it's a real asset and it holds that value. And we can see that like what happened in the past, like in the 80s, in the 70s actually, there was high inflation, and every time there was high inflation, land reacted positively to that. Some of you might be wondering, like, okay, is land values have gone up lately, like in the last 18 months, 2 years, so is that getting out of, is the market becoming a little too hot, and is there going to be a correction? But at the same time, what we found is like in history, like in the 70s, land values were going up, but incomes were pretty flat. So it was driven more by speculation rather than by genuine appreciation of farmland. But in the last few years, like the income of the farms has grown in tandem with the farm values. So what we are offering here is farmers have land, but this is a way for farmers to invest and diversify their portfolio. Invest not just in the county where they're in, but invest in farms in other parts of the country, helping farmers that are getting started or farmers that need a more sustainable financing source. So I will turn it back to Melissa.
Great. Thanks. So I'm going to talk to you guys about the Farmland Capital product. Farmland Capital is a product from FBN. It's a financing option for farmers that is not debt. It's equity financing, meaning we invest alongside farmers in the equity of their farm in a minority investment. We are absolutely trying to make a path to long-term ownership for farmers, meaning that we invest in always a smaller portion of equity than the farmer has. Most frequently, the use cases for a farmer is buying new land or refinancing their capital structure. You can see some of the use cases on the left here. And what that means from the investor side is that you are getting to partner with experienced operators. The farmer is maintaining all control and making all decisions on the farm, and also retaining all cash flows through the hold period of the investment. I'll talk a little bit in a sec about what that looks like on the outside, because the investor does make a little bit more on the appreciation side of that. But generally speaking, you're not doing any of the work of diligencing the farm in terms of trying to find a piece of land that's available for sale. You're not having to manage the land, and you're investing in that farmer themselves, who is an experienced operator, and it's a big part of the diligence process that Peppo and the team go through in terms of sourcing these opportunities. As I mentioned, a lot of these farms just aren't available on the open market, meaning we are not having to compete in some of these auctions that I'm sure you guys have been participating in, where land values are really getting bid up, and they're also, again, properties that folks are trying to hold on to. They're generally much more higher quality than the types of parcels that if a farmer does need to sell a certain parcel, they're not trying to get rid of. And again, you're in a lot of cases, particularly the case of a farmer trying to buy new land, helping a farmer get started, helping support rural ownership and rural ownership and a farmer that's going to continue to operate that land. So to dig into a little bit more of how the structure works, take that situation of a farmer buying new land. The bank on a $100 farm, just for simplicity's sake, is willing to lend up to 60% of the value of that farm. So that's the gray bar on the right side there. The farmer and investor are going to fund the remaining 40%. For a farmer, that 40% down payment tends to be a lot, and so that's where the equity investment comes in on the investor side. Again, we're saying for simplicity, split that down payment 50-50. In reality, it would be around 49-51 or less on the investor side. As I mentioned, the farmer is retaining all cash flows through the hold period on this investment term. So if you and a friend were to split this 50-50 down payment, you might expect that through the hold period, you would share the cash flows 50-50. In our case, we know how important cash flow is to farmers, and we want them to have that to reinvest in their businesses. And so what that looks like on the exit, when the farmer buys out the investor, is the investor receives an outsized portion of the appreciation. So if the farm goes up by $10, instead of splitting that gain 50-50, the investor is actually getting 60% of that gain, or $6, and the farmer's getting about $4, as well as being paid back their initial payment. So the two things you have to be aware of in this structure: one is a 10-year investment. The farmer can buy out the investor at any time, but they have to buy you out by 10 years. So it could be shorter, but you need to know that your capital is locked up for that period. You also have to believe in farmland appreciating. This is an investment, you can lose money, but if farmland appreciates, that is when you make money. This is, again, to dig in a little bit more on the win-win side of things. The left side, the left bar, is other investment opportunities in farmland. The right bar is our structure. Many of you know that investment opportunities in farmland equal the farmer not owning the land and the farmer paying rent. That is what the left side is. That rent is usually 2 to 3% of the value of the farm in a given year. And the investor makes money on that on an annual basis, plus at the end of the term when the farm is sold. And so that's what that roughly 6% is how much farmland appreciates on average per year. So that's about an 8.5% return per year. We don't like that structure. We don't like where the farmer is the tenant, and that's exactly what we're trying to avoid with our structure. And that's hence our owner-occupied model. And so because this, I will emphasize, is based on the same 6% appreciation per year, but because you're getting that outsized portion of the appreciation at the time of the buyout, the appreciation is multiplied, which is how we get to the 13% that we model. So it's about a 13% return per year based on historical USDA appreciation in land. And the reason we have this picture is not just to tug at your heartstrings, but to emphasize this point that the farmer is owning and investing in their land for the long term. And so that's average appreciation, but we do believe in this scenario where there are these shared incentives to build value for the long term. We hope that we can outperform the average. And so I mentioned the team a little bit earlier. Peppo and myself, I'm just reading, that's his nickname. And we've got Chief Economist Kevin McNew, which some of you may have met, as well as Graham on the data science team, and he's got a team supporting him as well, that all help us from not just the diligence side, but from the data science side in terms of helping to understand where farmland values are going, helping to us in understanding what types of parcels are uniquely suited to this kind of investment. And as I mentioned, have the full support of FBN behind us. So with that, I'll pass it to Peppo on the investments.
Thank you. So at this point, this is a farm that we invested a couple of months ago. This is an exclusive for Farmer2Farmer. We're offering this farmers the property in Illinois, a 179 acre farm, mostly corn and soybean. It's a property that is above the county average in terms of productivity. This is a property that has some residential real estate like development value, but it was valued as agricultural value, so that provides like some potential for upside for the investors on the property. It's a property that's been really well operated and managed. Farmers are applying manure on the fields, like improving the fertility, having a really intense rotation on the farm. And in this example, in this opportunity in particular, it's basically investing $278,000 in exchange for 37% of the changing value of that farm. If you look at the projected returns on these based on the historical appreciation, the returns both for the investor and the farmer are aligned, are the same. That's something that's really important for us. The farmer is getting the income of the property, but the investor is getting a little bit more of the future appreciation of the farm in exchange for that. But at the end of the day, both equalize, and both the farmer and the investor are looking at a very, very, very similar return. So the term of this is 10 years, but the farmer can buy it out earlier. And so we expect, like in average, farmers in average over 5 to 6 years is when they will be buying this co-investment out, based on how quickly they're building wealth on the property and they can refinance and buy it out. This is another property in Illinois. We have some space reserved also for farmers to invest on this property. It's a corn soybean farm, really highly productive property. It has an APH in soybeans of 88 bushels, has had yields of over 100 bushels of soybeans, so really top tier farm in the area. This is the total investment here again is $518,000, but you can invest as little as $10,000 on this property. Again, same expected returns both for the farmer and the investor. And then the next property, this is a livestock operation, is used mostly for dairy cattle. It's a farm in Missouri. It's been growing like most alfalfa and corn. The farm has been taking really good care of the soils of the property, applying manure, improving like the pK levels in the soil, and also having like rotations that help to build organic matter and have like a better infiltration and more water holding capacity in the soils. This is another opportunity where we also have a room reserved specifically for farmers to invest, and in this one we're based on historical appreciation of farmland. We're looking at a 14% return, both for the farmer and the investor. So yeah, this is a little bit of the summary, and what we're offering, like there's a special for FBN members where we are giving them a discount like on the fees on these. And that helps improve the returns as a special consideration for FBN members participating in this.
Great. You want to just go the next one? Great. So this is our website. You guys can visit for any more information. We're going to have, we have some time here for questions if anyone has any. These guys are going to bring out some microphones. But that is my email, mbermudez@farmersbusinessnetwork.com. As Peppo mentioned, if any of those investments, you can get started at just $10,000. We can accept investments only from accredited investors. Just to be clear on that definition, it's if you make $200,000 or more per year or have net assets of at least $1 million. And that for a given farm, even if that's your place of residence, it just counts. You cannot include your home, but the farm value is able to be counted. So any of those investment opportunities, as Peppo mentioned, the two that we've launched previously, we specifically saved space for farmers and to talk about here because we do think they're such high quality assets. And the first one, Pyramid Farm, we're just launching now. So if you're interested, please come speak with us or come now or down in the booth. And yeah, any questions, we're here.
Interesting concept. How do you structure the ownership then with the farmer being 51% and then I would assume FBN or its pool of money would be 49%? How is the business structure? How is it structured?
Yeah. So I'll talk about it from an LPGP perspective. That is actually, we have an individual fund that invests in each farm asset. So you as an investor, as you guys saw in the previous slides, what you're investing in is a specific farm asset. We do everything on the FBN side, and as I've mentioned, Peppo leads all that from the diligence side and then actually also from the closing side to make sure we close this all with the farmer and have funded and make sure it's good to go. And then that's when we bring it out to investors and have the investor participation. Those are also all code names for the farm. We don't share any names, we don't share locations because that's not what the farmer themselves is signing up for. That then what we do is set up a specific fund where investors are buying into that fund. Does that answer your question on the structure?
Yeah, no. I guess then from an asset standpoint, like the way this is structured is, let's say the farmer has or is buying a $1 million farm. The farm is getting some financing from the bank, let's say $500,000-$600,000 from the bank. So that is like a first mortgage that is filed on the property. The way we're investing here, like the other 49%, like 49% of the equity that we're coming, is up to 49%. Sometimes it can be less than that. It's structured as an option that is secured by a second lien on the property. So the farmer is still the owner of record on the deed on the property, and this investment is structured as an option that allows you to participate in that changing value of the farm. So there's an option to buy a percentage of the farm at a pre-agreed price. So then if the price goes up, the investors get to participate in that changing value of the farm. Mm-hmm.
So then a follow-up question would be, say year 6, I'm the farmer.
Yes.
It's $1 million farm. It's stayed at $1 million, but
Yes.
I want to get rid of the second, which would be your position.
Correct. Yes.
I have to pay 5.9% appreciation on that per year. Is that correct?
So if the farm hasn't changed in value, you can just return the same amount of money that you got. So
what if the farmland then drops?
If the farmland drops, there are two scenarios here. If the farmland drops and the farmer is selling the farm, both the farmer and the investor are in the same boat. If the farm, like if they're both losing money, then if the farmer is buying out the investor, they're not in the same boat. Like the farmer would try to buy it for, like if there is a dip in the market, land prices go down 1 year, the farmer might be incentivized to buy it out in that year, and the investor was thinking of this as a long-term investment, so wasn't counting on that. So in that situation, to align interest, the way the product is structured during the first 7 years, the farmer can buy, if the market goes down, the farmer can buy out the investor, but at least has to give him the money that the investor invested. So worst case scenario, like the farmer got the money for free, like didn't pay any interest during those 7 years. But then if the farmer waits until year 8, 9, 10, and the market went down, can return less than the money that he got to the investor. So the investor is participating both in the upside and downside, but there is this protection to align in, like when interests are not aligned with the farmer.
And just to put a fine point on it, anytime the farmer is requesting to buy out the investor, it's basically triggering an appraisal. And so if that appraisal becomes lower, it comes in lower than the current value.
Correct.
In the 7 years.
And
Yeah.
there's a whole process to make sure the appraisal is fair, like certified appraiser, one appraisal. If either party is not happy, then a second appraisal can be obtained. If they're less than 5% apart, they're average. If they're more than 5% apart, those two appraisers can pick a third appraiser, and then the two appraisals that close together are averaged. I think there's another question there.
Great. Cool. Well, we'll be around here for a couple more minutes too if you want, or go for it.
A question about sharing ongoing costs. So everything from real estate taxes, but also to things like improvement, drainage improvements to the farm, repairs, et cetera. How's that, repairs versus capital improvements on the land? How is that shared?
That's a good question. So the repairs, those are like the farmer's supposed to maintain the property, like pay the mortgage, pay property taxes, maintain infrastructure on the property. But if there are any improvements and they're paid by the farmer, they belong to the farmer. So let's say at the time of the investment, the farmer doesn't have tile. Then the farm installs tile in the property. So when the appraisal is obtained, the appraiser will be asked to come up with two prices, farm with tile and without tile, and the price without tile will be used.
Great. Well, thank you all so much for coming, and yeah, we'll be here for any questions. Have a good one.
Thank you.